Hi, and welcome back. It's a pleasure to be with you all. Sometimes in life you run into situations where you have to make a decision on whether to purchase a property or building or whether to lease it. How do you make that decision from a financial perspective? So today we'll cover lease versus purchase analysis. I am your host, Brian Shakarami, and let's get started. Often you run into situations where you have to lease a building for a long period of time, and you'd have to wonder whether it would make sense for you to lease it or to actually buy it. So whether you should lease or buy becomes a viable question that needs answering. And it's definitely a real life question. So what do you do? How do you deal with it? How do you answer the question? Should you buy it or should you lease it? How do you find out? And I'm not trying to sound like an attorney or an accountant, but it really depends. What does it depend on? It really depends on their respective costs. Whichever costs the lowest is your best option. How do you find out which one has the lowest costs? You basically have to reduce the cost of leasing and the cost of owning to their respective cash flows. Once we've done that, there are two methods to determine which one's the best. One is obviously the net present value, or NPV, and the second one is their internal rate of return. So in this segment, we're only going to look at the NPV, or the net present value method. So again, we'll start with the cash flows of the two alternatives. To obtain the net present value, you have to have a discount rate or a weighted average cost of capital. So if you are an individual, we choose a reasonable discount rate. If you're a corporation, your CPA can provide you an after-tax weighted average cost of capital. And we use these discount rates to come up with our net present value. Remember that we will be comparing the costs of the two alternatives. The net present value represents the costs of each alternative. And so whichever has the lowest cost, that's the option that we will choose. So in summary, if the net present value of owning is less than the net present value of leasing, then owning costs less. We go with owning. However, if the net present value of owning is greater than the net present value of leasing, then we will obviously go with the leasing option because leasing costs less. To do this, we will start with the cash flow analysis, which starts with our T-bars. For the purchase, for the number of years that we own this property, we'll start with our initial investments and our cash flows, all the way to the number of years that we dispose of the property, which will follow with a sales proceed. And these numbers are after tax. For the lease cost, again, we'll start with the lease payments for year 1 through however many number of years that we are leasing the property, which should be the same as the number of years that we own the property, so we can compare them, apples and apples. But also notice that this lease payment must be the after-tax numbers based on the corporate tax rate. And I believe the best way to drive our point home is through an example. So we will start with Trump Plaza, one of our president's building. Donald Trump is looking at a commercial building, pondering whether it would financially make sense to lease it or to purchase it. The whole time, if he were to acquire the building, would be 20 years. He would also lease it for 20 years if that was his go-to decision. There's really no financing involved. He's going to pay cash for it. And we want to use the NPV, or net present value method, to find out what we should recommend to Mr. Trump. Should he buy it or should he lease it? Below you will see the building size, 40,000 square feet. Holding period 20 years, purchase price acquisition cost, improvement allocation, which means that 80% of the price goes to the building and therefore 20% goes to the land. Useful life, because this is a commercial building, is 39 years. Annual growth rate of 2%. Projected cost of sale at the time of disposition is 4%. And this is Mr. Trump's tax rates. So the amortization period would be 20 years. There is no loan here, so we don't worry about that. Next thing that's important is the leasing information. The rent per square foot for year 1 to year 5 is $29. And notice that there's an escalation here. From year 6 to 10, the rent has gone up by $2 to $31 a square foot. From year 11 to 15, rent's gone up another $3 to $34 per square foot. And from year 16 to 20, there's another escalation of $2, and we'll end up with a rent of $36 per square foot. Given all this, let's do our cash flow analysis and see what information it can provide us to help us answer the question of whether Mr. Trump should own the building or whether he should lease the building. So we'll start with the leasing cost. From year 1 to year 5, we started with our $29 a square foot. And from years 6 to 10, we had an escalation. Therefore, the rent goes up here. Again, from year 11 to 15, we had another rent escalation. And from 16 to 20, we had yet another rent escalation. And the corporate tax rate was 21%. So therefore, we take 21% of the rent to get the after-tax cash flow. And once we have the after-tax cash flow of year 1 to year 20, we would then be able to find out what the net present value of all these cash flows are in 20 years. Lo and behold, at a weighted average cost of capital of 6%, which was reported by the Trump Corporation, the net present value here would be $11,470,411. This is the after-tax net present value based on the after-tax cash flows. So then we move on to finding the net present value of the cost of purchase. To do that, we start with our initial investment and all the costs associated with the acquisition of the property. In an ownership scenario, we really don't have a potential rental income, so therefore we don't have an NOI or a net operating income. However, we will be able to deduct interest, if any, but in this case, we don't have a loan. It was paid cash, so we don't have any interest to deduct. However, we would have cost recovery, recapture to deduct on a yearly basis. So we deduct that for 20 years. And also a tax liability of 21%. That needs to be deducted as well. So therefore, our after-tax cash flow would come from the deduction of a combination of cost recovery recapture from the improvement and the tax liability. Here, the acquisition cost came out to $110,000. Therefore, our total initial investment would have been $25,110,000. Our sales price was developed based on projecting based on a 2% growth rate for 20 years. Therefore, we projected the $25 million investment into the future for 20 years at a 2% discount rate or interest rate, if you would. So therefore, the number that we come out with for the future sales price would have been $37,149,000. However, by the time we deduct the cost of sale and the ordinary income tax savings at 21% and cost recovery recapture and capital gains tax, then we end up with $31,292,355, which is our disposition sales proceed after tax. So now that we have all these cash flows from year 1 to 20 after tax, we have our initial investment and we have our after tax sales proceeds, then At a weighted average cost of capital of 6%, it would be easy to determine what the net present value is. And that number comes out to $14,117,742. So now all we have to do is compare these costs. Cost of owning was $14,117,000. Cost of leasing was $11,470,000. Clearly, the cost of leasing is less, so we go with the leasing option. This is a no-brainer. So in conclusion, we just covered the net present value method of deciding whether to lease or to purchase. As always, if you have any questions regarding what we just discussed, please drop me an email to the link above, and I'll be happy to get back to you. Thank you for your time.